I am today going to be talking to you guys about USDA loans and why you are getting denied for your USDA loan. Because who likes getting denied? I sure don't. Hello, this is David Zai with the Zai Mortgage Team. People are denied every single day because of a a rule that's not very known to loan officers that don't do USDA loans every day. And that is, if you can qualify for a conventional loan, then you do not qualify for a USDA, which is a rural, a lower income type loan. A lot of times we'll pull up the calculator online to check our income, our household composition, and we'll say, hey, based on this, I qualify from an income standpoint. It's great. Check one, right? Check two is, I need to make sure that the address is in a USDA defined area. Fine, it checks off. Check two. So you see this map behind me? I'm tracking the USDAs all the time for you, just to see the areas that do qualify for USDA. However, check three is the one thing that loan officers typically stumble on. And I'm here to make sure that you don't stumble on those issues, because when you get your hopes up for buying a home that you truly do like and you've invested time, energy, and effort into it, I want to see you succeed and get that home. So first of all, what constitutes someone that qualifies for traditional conventional financing? Number one, you have available personal non-retirement liquid assets of at least 20% that you can put into the property as a down payment. So if you have 20%, why would you need 100% financing, right? That's what USDA is thinking. Number two, you can not only put the 20% down, but you can also pay the closing cost on the loan to cover everything. Number three, your debt to income ratio. Looking at your debt to income ratio, and the way that this works is we have a front end debt to income ratio, and then we have a back end debt to income ratio. The front end debt to income ratio means what is your housing payment versus your non-taxable wages. So we're just going to use some simple numbers. Let's just say you make $2,000 a month gross before tax, and the housing payment's $500. That's 25% debt to income ratio. The back end ratio works like this. That means we're going to add all of your income. Let's just say it's still $2,000 a month. And then we're going to say now you have $500 for the housing payment, and then you got $100 in monthly debt, like credit cards and maybe even a small student loan that you have to pay for, right? So 600 versus 2,000, that is a 30% debt to income ratio on the back end. In order to qualify for a conventional loan, we are typically looking at a 28% front end ratio and a 36% back end ratio after applying the 20% down payment. And if the underwriters see that, they may deem you not fit for the USDA loan. And then finally, the fourth thing that's really important is that, you have demonstrated like quality or qualifying credit on the loan to be able to get the 30-year loan with the down payment and not having to pay for private mortgage insurance. If you can do that, then you do not qualify for the USDA loan. So make sure you check all those boxes. You're looking at your debt to income ratio, you're looking at your down payment, you're looking at your assets. Now we're going to go into the asset part, because that's really important, right? When you're declaring your assets on a loan application, some of the things that we're looking at that we would consider cash or cash equivalent does not include your retirement plans, like your 401k, your Kehoe accounts, any type of retirement account that has some sort of restriction or a penalty for pulling out the money early. And then also land that you own will not be considered an asset. So those two things are good to kind of declare. What do we use to determine the 20% down payment and the cash equivalent? Well, obviously your checking and savings account. We're also looking at your investment accounts, such as stocks, bonds, mutual funds. And then we look at CDs, like, your certificate of deposits or money market funds. Unless they were some sort of contingency on the withdrawal, then we're going to have to look at all three of those cash equivalents or cash type accounts and count those against you and say, hey, you have the ability to put the 20% down or not. So when you are picking your lender for the USDA loan, it's really, really important that you're picking a lender that knows the guidelines of the USDA loan, so you don't check off two of the three boxes and get declined or denied for the USDA loan. The other thing that's really important is that you are constantly shopping for this loan, okay? You know who you are looking for. You know that you're either working with a retail lender or a wholesale lender. Retail lenders, they work at a fancy building. They have to pay that middle level management. And then a wholesale lender is one that doesn't have all of that. and we sell it directly to the investor, so we're personally shopping for you. If you have any questions or concerns on getting a USDA loan and you want to get all 3 boxes checked out, please give me a call. My name is David Zai. I'm with the Zai Mortgage team. I can be reached at 757-478-8493, and I will be honored to help you out. Bye.